Hello, hello, everyone. Happy Monday, good afternoon, good evening, good morning. Well, let's say good afternoon from Verona. How are you doing? Despite what's happening all around the world nowadays, I promise I'll try my best to keep it up and keep your mind busy for just around 30 minutes. For all of you being on Zoom with us for the very first time, I'm Paolo Rigo. I'm a creative numbersman with a very big mission, helping people how to make a living balancing money and happiness. I'm the CEO and founder of Studio Rigo that goes under my name. I'm a tax expert certified by the Chamber of Commerce, assistant for the judge at the Civil Court of Justice of Verona, working with chambers of commerce, embassies, and consulates from all over the world. I'm also a proud member of the European Institute of Advanced Study in Management. Today, we're talking about one of the most hated topics for foreign taxpayers in Italy, the wealth tax. Before we begin, I want to say thank you for all of you for trusting us and for supporting us and to be here with me today. I'm going to share my screen with you, so please keep your mic muted. And if you have any questions, feel free to use the chat box in the bottom. And at the end of the session, probably around 15 minutes from now, we can address every question, and if you want, we can join us live. Hope you like with that. So let's begin. Here we go. As you know, once that you become an Italian tax resident, it means that essentially you spend more than 183 days. You consider a taxpayer. Being a taxpayer leads to another obligation. It's filing your taxes at least once a year and pay your taxes between June and November of the following fiscal year. As you know, the tax firm is divided into different frameworks, and one of them is the RW section. And as you can see here, the main goal is to avoid the advantage of holding assets outside of Italy. So a very common question is, what happens if I own some investment in Italy? Do I have to declare them? No, it counts just for foreign assets, foreign bank accounts, pension accounts, real estate, investments, whatever. And the section is the RW. Let's move forward. What is the tax basis? Well, the tax basis is very simple. As I used to say during the calls with the clients, is everything that goes under your name. So bank accounts, lately we will see if the average stock is more or less than 5,000, but anyway, certificate of deposit, investment portfolios, so cryptocurrencies are also included, foreign bonds, life insurance, investment funds, stock options, private shareholdings, pension funds, gold and precious commodities, and cryptocurrency. Just two very useful informations. About bank accounts, we will see later, but bank accounts are taxable only if the balance is more than 5,000. And then regarding pension funds, very often I hear this question, do I have to pay the wealth tax on my foreign pension, on my foreign account? It would be a lot of money. Well, more likely, no. You don't pay taxes on the foreign bank account, sorry, on your foreign pension account, until you start withdrawing money from that. So it will be considered tax-free, and you will pay taxes on the money that you withdraw from the private pension fund or public pension fund. It will be considered personal income. Very clear about that. Pension funds must be put in the tax return. So they must be present in the RW section, but more likely you don't have to pay taxes. So please remember this very useful information. You have to deliver all these informations that you see in this picture, but more likely you have to pay just for a few of them. The wealth tax is the 0.2% of the asset value as December 31st, the 0.2%. Very often, there is a tax rate enforced between the country where you hold this money and Italy in order to avoid dual taxation, because it wouldn't be fair to you to pay twice as much, right? So very often, you can deduct all the taxes paid in your home country from the total due here. It's 0.2%. It's due per year, and the payment is due by the end of June of the following fiscal year. Very important information about bank accounts. Bank accounts only pay a flat tax of 34 euros per each bank account, only if the average stocks is more than 5,000. I hear a lot of people thinking about themselves, speaking loud during the call, saying like, well, maybe before becoming tax resident, what if I cash out all my investments and I put them in the bank account? So I will not have to pay the 0.2%, but I will pay just 34 euros. And what do I respond usually? I say, yes, you're right. You're trying to think like an Italian taxpayer. Bank accounts, it doesn't matter how much you have, you pay just a flat one of 34 euros. More than 5K, up to 5 billion, still 34 euros per year for each bank account. And for example, if you own a bank account with your spouse, with your partner, you just pay 50% of that, so 17 per year. As you know, on real estate properties that you own abroad, you have to pay the wealth tax. And this is pretty tricky because very often people think that just a flat percentage could work. Well, not really, or let's say not only. This property tax on for real estate goes for 0.76%. On what? Well, then it's the right time to discuss on the tax basis. Basically, we have to choose, or we have the privilege to choose about cadastral value, cost or acquisition value, and the market value. Very often people reach me out and say, Paolo, okay, I hear that, I hear what you're saying, help me picking the lowest. Well, it definitely makes sense because no one wants to pay more than what is due, but it's very hard for me to help you out if you don't have the right documents. Usually, if you have some official documents proving one of the three, more likely we can pick that. And if it's the lowest, well, good for you. Of course, if you see that the market value, for example, the current value nowadays is 1 million and you paid just 200,000, definitely we have to find a legal way out of any tax order in the future. But if more or less the difference is less than 20 or 30%, yeah, you can pick the lowest and pay just the 0.76%. And good news, here in Italy, you can deduct all the property taxes paid abroad. 99% of the times, the tax rate in force already provides that. And very often, for example, for US citizens, we see that the real estate property has to pay a higher tax rate in the home country than the total due here in Italy. So in other words, even though the percentage might scare you because it's more or less 1%, you don't have to pay a thing if you already paid a way lot more in your home country. So as I used to say, don't think bad things about Italian real estate taxes. Think positive. It doesn't cost a thing. Don't be so sure that you have to pay something. Apply the 0.76% on the gross, deduct all the taxes paid in your home country and see. Maybe there is nothing to pay. Who knows? Capital gains. Okay. Between you and I, this is probably the most hated tax ever because it's a flat one. 26% on the cash basis, on dividends, interest, and real estate. Why I put 5 years rule? Because here in Italy, you pay 26% on capital gains on real estate only if you buy and sell within 5 years. After that, you don't have to pay it. 26% is very unfair from my point of view because the tax basis is the gross. And even though the tax treaty can minimize that, it just goes with minimizing the tax basis. I'm going to give you an example. Let's say in your home country, you pay 10% and the gross is 100. So the net basis will be 90. And on the 90, you will pay the 26%. So this discount is not something that you can deduct from the taxes themselves. It's a discount that you can deduct from the tax basis. So doing the math, in this case, more likely we can find a dual taxation, less than just 1.1 plus the second, but 26 plus an average 5 or 10% that you actually pay in your home country. So capital gains here in Italy are very heavy to keep. Think twice before cashing out something. And this goes to another thinking. the 34 euros due on your bank account. If you cash out before becoming tax resident, you save the 26%. So remember, timing on the tax strategy is everything. What if you skip a deadline? What if you don't declare something simply because you didn't know, or your tax consultant didn't know about that, or simply because you forgot about it? It may happen, right? Well, I let you make a mistake in the personal income tax. I let you make a mistake in the deductions, but for foreign assets, you will be liable for a fine up to 15% of the asset value per tax year. I don't want to scare you because I don't like you to use fear, but nowadays I see thousands of people receiving audit from an every agency because you know what? We are in 2022. They already know what you have. So please double check that the RW section of yours is already completed, is okay with your real estate, with your properties that you own abroad. And if you made a mistake, if you forgot about it, don't be desperate, okay? Don't think bad. You can get back in the previous 4 years and fix it. With some fines, with some penalties, but definitely a way lot less than the 15% of the value itself. So you're still in time to fix it. Don't forget to file your W section about the real estate that you own in your home country. Even though it's just one property you own, it must be present. Save the dates. RW filing Modello Redditi by the end of November of the following fiscal year. Very often I hear people scaring simply because they think that once they become tax resident, they have to start pay for something. It doesn't work this way. It doesn't matter if you become a taxpayer on January 1st or in December 31st. Still, if you're talking about fiscal year 2022, the first tax obligation will take place between June, as you can see, between June and November of the following fiscal year. So try your best to find some peace of mind, relax, you have time. Here, the calendar year and the fiscal year are the same. So regarding fiscal year and calendar year 2022, we are talking about June and November of 2023. Why 2 payments? Well, this is kind of funny because here we have the ultimate deadline for the tax filing by November, but then you have to pay the first round of taxes by June. So more likely we can agree on the fact that by June, you should have your tax return, at least as a draft, prepared by your tax consultant. I try my best to make it as quick as possible because I know that taxes can be very annoying. And I wanted to hear some question of yours. So, well, of course, a big thank you for being here from me and my team. Now I'm all yours. I'm going to stop sharing my screen with you. And if you want to talk to me, just hold your hand or click on the button, whatever works for you. I'm all yours, or you can submit your question in the chat box. Who's the first one? Oh, I see as an Italian surname, Francesco. Okay. I'm all yours. Are you there?
Sorry, I need to unmute. Okay, I'm good now. How are you?
I'm great, thank you.
Good to see you again. So I have a question with the, in terms of real estate. Okay, finally, after 2.5 years, I'm coming to Italy this Saturday, which I'm thrilled about.
Cross your fingers, right?
Well, cross my fingers, yes. Okay, I'll do that. I've been praying, crossing my fingers, doing everything I can. But so if this is my first tax year, what happens if I sell my home this year?
Okay.
Or even next year, within the first 2 years?
When did you purchase the property?
8 years ago.
Great. More or less than 5 years. What do you think?
Yeah, less. Good.
Great.
Meaning?
I didn't say anything.
Okay. Can I hear
Remember,
it?
yeah, remember, when you start to wear the Italian suitcase, you have to think like an Italian. Don't assume that you have to pay something simply because you have to in your home country. Different country, different rules. It could be a good, it could be a pros, it depends. But actually, if it's more than 5 years, you don't have to pay a thing.
Got it. Well,
do you feel better?
Absolutely. Of course I do. Of course I do. Yeah.
Awesome.
Excellent. Excellent. Excellent.
I see a question from, hold on. I'm not trying. Okay. From Cloud TG, are US government public pensions taxed in Italy? Okay, are you there? Can you hear me? You can join.
Can you hear me?
I can.
Okay, good. No, hey, Paolo, how you doing today?
I'm great. I'm great.
So I'm not sure about the public pensions. It's not I guess it's not wealth tax, but income basically from the public pensions. I thought they weren't taxed.
Okay,
per the treaty.
it's a little bit out of topic, so I apologize for all the listeners right now. I hope you find it interesting anyway. But let's say that it's all about not the pension itself, but the source of your income. What did you do for a living?
I work for the federal government, U.S. federal government.
Perfect. I'm going to whisper. It will be tax-free.
Okay, good. Okay, because I misunderstood something you said earlier. That's good.
Based on Article 19 of the tax treaty between Italy and US, you can double check.
Okay, great. I have one other question for you. You know, your tax tool you sent out, the spreadsheet?
Oh, sorry. Can you say it again? You cut off for just one second.
The tax tool you sent out, you know, the spreadsheet?
Yep.
So there's an area that says investments, funds, and stocks.
Yeah.
Is include 401k in there?
The 401k is considered a private pension fund.
Okay.
And it's considered tax-free until you start withdrawing money.
Okay. So it's not part of the wealth tax.
Not at all, but it must be put in the tax return. Don't forget about it.
Right. Okay. Thank you. Great.
Do your homework.
Yeah, appreciate it. Thank you.
You're very welcome. Okay, Gary Foster, the 5-year rule is basically simple. If you buy and sell within 5 years, you have to pay the 26% on the capital gain. Otherwise, it's tax-free. The 7% rule, well, it's free. It means that you don't have, if you're eligible for the 7% for pensioners here in Italy, if you're a brand new resident, you don't have to pay their wealth tax anyway. So I wouldn't mind about it. For foreign pensions, okay, sorry, but this call is just about for real estate, not for personal income taxes. I'm really sorry to disappoint you about that. We will schedule another one. If I become a tax resident in 2023, when do I have to file the tax forms? By November 2024. Definitely you can hit on pause on your panic attack, relax, and wait until June or November of 2024. Laura, I have a Roth IRA and IRA accounts in the US. So neither of these will be subject to the wealth tax. Laura, are you here? Can you hear me? Okay, I see someone shaking their hand. You can join if you want. You have my blessing. Hello. So
Hello.
When you said I have a Roth IRA and IRA accounts, subject, you're meaning paying taxes on, right?
Well, I know that the withdrawals will be personal income that's going to have to be paid.
Okay, we are talking about paying
Well,
taxes, and I can confirm that you don't have to pay a thing. But remember that you have to put those informations in the RW section. There's just a flag that you can click on that is considered tax-free, but there must be put in the tax form.
All right, but let me back up a minute. You just said that they're pension funds, so they're considered tax-free, but you mean just for the wealth tax, not for
The fund, the balance, okay, the account itself will be considered tax-free. The withdrawal, okay, the money that you take out of it, it will be considered personal income. So totally different topic.
Right. Okay.
As long as you keep the money there, you don't have to worry about personal income tax. You don't have to worry about taxes at all.
Great. Okay.
Adrienne, I see. Can I ask one with a smiley? I love that. Hi, I can see you. Yeah, you're on.
Can you
Hello.
hear me now?
I can. And I love your blue background. I love your atmosphere behind you.
Oh, I'm in my bedroom on my bed. I have mood lighting on the side. Anyway, I actually have two questions. It's
Wow.
they're about stocks.
Okay.
So I'm from Australia and I have a portfolio I'm thinking about becoming a resident soon. When you become a non-resident in Australia, you're deemed to have disposed of your shares. So I have to pay tax to the Australian government on those. However, I plan to keep some of these shares for a lot longer. How will I then be taxed on those shares when I do dispose of them as an Italian resident, if I've already been taxed by the Australian tax department?
Well, first of all, I would like to take a look about your tax return, because more likely we can deduct all the taxes paid there. But let's say that you receive the gross or you have the gross. On the balance of your stocks, you should pay the 0.2%.
Okay. And then I know the flat tax is 26% on capital gains.
Yeah.
But what about, is there any discount for holding shares for over 12 months in Italy, or it's always just a flat 26%?
It counts only for the investments that you own abroad. In Italy, we have a different kind of taxation. Here we have a withholding tax of, let's say, 13% rounded up, and then you pay a balance. We have the capital gains, we have the capital loss. So the RW section is just for assets that you own abroad.
Right, okay.
So what you can do maybe is to get in touch with a financial advisor and work on a couple of estimates or scenarios to see what happens if you realize the cash out under the Italian law or as a RW section.
Okay.
What do you think?
Yeah, maybe that would be helpful, because I'm in the stage where I'm trying to figure out what to do, because it's most of my life savings in this portfolio. So
I know. You know, I have a quote I use a lot: rather invest 1 hour with a professional than 1,000 with the IRS or the revenue agency in fines. So you can find plenty of free guides on YouTube, on Google. Just find out what is the tax rate for Italians products, financial products, and then you can work on an estimate.
okay, I'll give it a go.
Awesome.
Thanks.
Well, I see. What does dividends and capital gains in the US apply against Italians? So if you pay 15% dividends in US, you own Italian. 11%? No, you still have to pay the 26% on the net basis. So let's say you make 100, you already pay 15%. So the net basis is 85. On the 85, you pay the 26%. I have US mutual funds inside my IRA account. So I need to change those investments to avoid taxation. Wow. This is a very complicated question. It's not something that I am allowed to tell you just standing on my feet about, because it could impact in a good way or in a bad way. Let's say that if you can change this kind of investments into a private pension, more likely they can be considered tax-free. Based on my experience, just on average case, but I cannot be 100% sure. As you know, I hate very long conversation. I hate to keep talking about taxes because it's a very annoying topic. It's always something to pay. And in case you have more questions, and I truly hope you have, or you get some in the following days, remember you can get a lot of free content on our YouTube channel. You can Google it just for Studio Rigo. And also feel free to send us an email at studiorigo@gmail.com. And you can book 15 minutes call with me. Yeah, the face that you see right now, just me. I hope that you find this session, even if it's brief and quick, useful enough for your future. If you found this information to be valuable to you, please don't forget to share your experience and tell your friends, spread the word on social media, wherever works for you. We want to touch millions of people. We want to update people, inform people. Thank you again for showing up today. And for all of you that are supporting us, donations are always very, very deeply appreciated. Once again, I'm here. If you want to get in touch with me and my team, you can schedule your free session. I swear 15 minutes of my time just for you to make you feel better about the decision that you want to make about moving here in Italy. And this is a very inside information, but you already know more videos and smart tips to come on YouTube and Instagram. So stick around. Have a great day, everyone. Thank you again for sharing your time with me. Ciao. Take care.